Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion, we will be talking about the accumulation distribution indicator. This is an indicator that helps measure volume and can give us a better idea of which way the market is going or which way the market might be preparing to go. It's an invaluable tool as part of a technical analysis repertoire that any trader that hopes to pass the Gauntlet Mini should be aware of, because it may just be exactly what you need to push yourself over the edge and pass that Gauntlet Mini and become a professionally funded trader. But before we go any further, let's stop right now and do me a favor, click that like and subscribe button down below because it helps me out a great deal. Thank you all. And now let's get back to that material. When the accumulation distribution indicator, otherwise known as the AD indicator, is paired with the right risk management tools, it can very well be something that allows us to more accurately interpret the trends, the reversals, and just gain a better overall insight into what is going on and what the market's behavior currently is. But let's start off with the definition of exactly what an AD indicator is. It is a volume measurement tool that assesses the cumulative inflow and outflow of money of a given security. It measures the price and volume of an asset to ascertain whether it is being accumulated or distributed. So in that regard, the name is very accurate. And you might be wondering, well, why is this important specifically? Well, it's important because it provides insight into the strength of a trend. For example, when the asset price is on the rise, but the AD indicator itself might be falling, this can indicate that the accumulation or buying volume is not strong enough to support that rising price. These circumstances could mean that a price drop itself could be very imminent in the short term. The AD indicator might look different depending on which platform you're using, but for the most part, it's going to be a line that is moving its way along below price. The AD indicator is not something that directly overlays price. Instead, it's something that will be created in a subsection below price, and you'll see it kind of moving up and down between some numerical values on the side. The person that invented the AD indicator was the famous trader that some of us are familiar with, known as Marc Chaikin. He was initially referring to this indicator as the cumulative money flow line. And at the time, he only intended it to be a savvy stock selection tool. Traders could pick a stock to buy based on how quickly volume grew and how much money was flowing into it. This was the idea behind using this indicator to help those traders find the stock. And over the years, the accumulation distribution line, as we see here, has become a very popular indicator in other markets, including Forex and futures. So how does it work? The accumulation distribution indicator looks at the relationship between an asset's price and its volume flow to determine the trend of a stock and the strength behind that trend. Accumulation basically refers to the buying level for that security within a given period. On the other hand, distribution refers to the selling level for that traded security. When the price of the asset goes up, more and more buyers want to enter the market. As such, the accumulation level should be growing with the rising price. Conversely, when the price is going down, sellers want to offload their shares, and the distribution level will inevitably reflect these changes. In this way, traders can predict the security's future price trend as well as potential reversals by paying attention to the indicator. These predictions will allow, with a reasonable degree of accuracy, traders to go long or short at the appropriate time. So how does this line here show this? Well, the AD line denotes a running total of the money flow volume for a given period. First, we calculate a multiplier based on the closing high-low range, and then we multiply its value by the volume for that period, which gives us the money flow volume. By plotting these values on the chart, we then end up with the accumulation distribution line. In this chart, we can see the relationship between the AD line, which is the gray line up top here, and the stock price variation, which is the orange line down here on the bottom over the same period. When the price was low, the AD line took a slight dip, and then when the price of the AD indicator went high, we also notice a price rise in the stock as well. As you can see here on the right, as we rise, both rise, as we fall, both fall. The AD indicator tells us a lot about market behavior, specifically what impact demand and supply have on the asset's price that we're looking at. Having all of that information allows us to make more informed trades. It tells us whether there are more buyers that are accumulating or sellers distributing in that particular market. It also helps us identify if there's a divergence between the price and the AD line itself. For example, if the security is in a long-term upward trend, but the price has recently gone down, it can mean that the demand is starting to falter. Sellers are gaining more power, and the market itself could shortly follow suit. The AD line itself will generally begin moving away from price, indicating that a reversal may soon occur. The formula for how the AD indicator is calculated can be viewed here. If you're interested in recording this down for practical purposes, or just interested because you like formulas, then I would recommend pausing the video because I don't plan on spending a whole lot of time here. But essentially, this is what we have. We have the AD equal to the previous AD plus the current period's money flow volume. Then we have the money flow volume, which is equal to the money flow multiplier multiplied by the volume for the period. And then we have the money flow multiplier equal to the close minus the low minus the high minus the close all over the high minus the low. Once again, this is not necessary, just pay attention to it if you like formulas. Other than that, let's keep moving. With this graph, we can see how the AD values make up the accumulation distribution line, although also known as the ADL. And the ADL itself is a cumulative measure of the money volume flow for a given period, like we said. Intense buying pressure moves the indicator higher, while strong selling pressure moves it lower. We measure the AD line in relation to the price trend, and then either confirm or contradict what is going on by taking a look at that line in relationship to it. This aspect makes the AD indicator an excellent tool for reinforcing the underlying trend and spotting reversals when we start to see those divergences. Let's take a moment to talk about how using the indicator actually looks. With volume itself, we know that volume is something that precedes price in trading. This is the cardinal rule of using the AD indicator. The number of shares traded is relative to the asset's price movements. If we use it correctly, the AD indicator can help us as traders predict the volume flow direction, and doing that can help us better estimate the resulting price movements that are coming. And as we mentioned earlier, the accumulation distribution line gives us insights into a traded asset's supply and demand. The aim is to read the direction of the line and determine the buying or selling pressure behind the underlying trend. As we were saying, a rising AD line indicates that the market is in an accumulation phase. If the line is falling, then it would denote that the market is in a distribution phase. In either case, we want to be sure to confirm the trend direction with other technical indicators or just outside price action before we execute. But what if the AD indicator and price are in an agreement? That just makes us more confident that the current trend and the prediction that we have for those future movements is all the stronger. If we have the line going upwards and price is also going upwards, this is an indication that that upwards trend is a strong one. And if price is going downwards and we have the AD line going downwards as well, this is also an indication that we're dealing with a more powerful bearish trend. When we have price rising but the AD indicator is falling, this is an indication of a divergence, and we very well might be getting ready to witness a reversal. The key points that go into spotting a trend and confirming a trend with the help of the AD indicator can be seen here. When the AD indicator and asset price both make high peaks and high troughs, the upward trend will likely go on for a while. When the AD indicator and the asset price both make low peaks and low troughs, the downward trend will likely go on for a while. If the AD indicator is rising over a given period, then buying pressure may be mounting, which signals a potential upward breakout. If the AD indicator is falling over a given period, then selling pressure dominates the market, which could also signal a potential downward breakdown. Then come the divergences. When the price continues to rise while the accumulation distribution indicator falls, it could mean that the upward trend may stall or even change direction, and that's what's classified as a divergence like we talked about. And when price keeps going down, but the AD indicator itself is rising, it could mean that the downtrend is likely to stall and the buying pressure may soon overcome the selling pressure. So one scenario up here at the top would look something like this. If we have price rising, but the AD indicator is not rising or falling, that's an indication that we very well might see price chase the indicator and begin falling. Then down here, we have a situation where if price itself is falling, but the AD indicator itself is rising, this is an indication that the price fall itself might be reaching its bottom, and then soon we'll be following the path of the AD indicator looking to rise higher. In summary, the AD indicator is relatively simple to understand as well as use on the fly, and as such, it's often considered to be a more beginner-friendly indicator as you're working your way into the technical analysis world. It's beautiful because it allows us to further confirm our suspicions of a trend. If we view a trend rising and then we look at the AD indicator and it is also rising, therefore we now have a stronger confirmation and another layer to confirm that we are witnessing a strong bullish trend. The same goes true with bearish trends. If we view the market falling and the AD indicator is also falling, that could be an indication that we are seeing a powerful bearish trend. Now, when it comes down to it, the divergences are another powerful tool that can allow us to spot reversals in the market, which is another aspect of the AD indicator that I personally very much so enjoy. As with all things, you want to use confirmation and further technical analysis and knowledge of price action before you execute based on the information that the AD indicator is providing you. The AD indicator does not take into consideration price gaps, and as such, there could be a scenario where the AD indicator looks a little bit different based on the open and close of the market, and you need to be aware of that. But as with all things, just make sure you practice before going live, and I'm sure you'll do just fine. Best of luck out there, all of you. I wish you the greatest of success on your Gauntlet mini journey. I will be here waiting for you on the other side. Cheers, everyone. Bzz.